Good afternoon and welcome to NYFP. This afternoon I'm joined by Todd Schoenberger of LandColt Trading. Hi Todd, thanks for joining me today.
Thank you for having me.
Well, volatility is back in the markets with the major averages sliding by as much as 4%. Now the Dow is down by only 400 points as opposed to more than 500.
Right.
Are you surprised at what we're seeing today?
Well, actually, what I'm surprised about is that we're not down much more. I'm figuring we should be down about 600-700 points. Look, this is a market right now that there is zero optimism that's out there right now. You have nothing that can really propel the bulls to really start another rally. So until we start seeing some evidence that things are recovering from a global economic picture and also from an outlook for earnings, we're not seeing that. So the bulls are saying, look, we're going to run, we're going to hide, we're just going to sell out of this market right now.
Well, Todd, in terms of the fundamentals we got out this morning, some of the economic data was to the downside. And all those Eurozone sovereign debt concerns, of course, they haven't been resolved. But heading into tomorrow's session, what do you expect to see, especially since we do have options expiration on Friday?
Well, continued volatility. There's no doubt about it. I mean, you're going to see the VIX continue to increase. You're going to have an up and down pattern, especially tomorrow. But realistically, though, the overall trend for the immediate future is definitely on the downside. So you're going to see a continued weakness in the markets. Chances are we're probably going to be seeing another 8 to 10% sell-off from these levels alone. So investors want to be prepared. What they should have done is sold into strength during that 3-day rally if they were still holding on to anything. But investors are naive right now if they're thinking this is just a rough patch. We are in for a prolonged bear market.
Well, Todd, since you mentioned bear market at the end of this month, we do get Fed Chairman Ben Bernanke and other central bankers meeting in Jackson Hole, Wyoming. And that does also coincide with the end of the temporary short sell ban of financial stocks over in the Eurozone, at least for some nations. What do you expect to see from the Fed?
Look, you're going to have, out of the Eurozone alone, that's clearly a poison place. I mean, they're not experiencing any growth right now. You have France. I mean, this is a big issue because from a worldwide perspective, here in the United States, you have to worry about our multinationals. Remember, a company like a McDonald's is a great example. 40% of its revenues come from Europe alone. Coca-Cola is another one where they have a bulk of revenues. Philip Morris, I mean, big Dow components. If they're struggling in the Eurozone, that's going to clearly impact what our domestic stocks are going to do here. As far as what the chairman's going to talk about in Jackson Hole, what can he say? I mean, he's already locked in on near zero interest rates for the next 2 years. We now have an economy that's stuck in quicksand. We have an unemployment rate that continues to go up. The macro data is just horrible right now, and it continues to get worse. So from a trader's perspective right now, you have to think, what else is out there? The chairman really has cornered himself right now because he can't raise interest rates because even though we may have an inflation risk, as we saw with the recent inflation data, and that yet again, he needs to start doing something as far as printing more money, maybe another third round to try to stimulate this economy. Overall, though, this is not looking good, and the chairman probably has himself to blame for all of this right now.
Okay, Todd. Well, now that we've covered the broader fundamentals, last but not least, before I let you go, we've been getting mixed earnings out from the retailers. What's your take on the sector?
Look, retailers do great when they have inventory control. Nordstrom, Ann Taylor, you go into those stores and you ask for merchandise, they don't have it in the back. That's called inventory control. Whereas you go to a Talbot's, they have 50% of their inventory in the back. You can't sell stuff if it's in the back room. So from a retailer's perspective, clearly the higher end earners, Ralph Lauren, Saks, they continue to do well. Nordstrom and Taylor is doing well because women are still spending money, which is actually a key bullish proxy for the markets, which is actually good. But when you start looking at some of these other retailers, TJ Maxx, Limited, they're Abercrombie and Fitch, their outlook continues to be poor. They have higher commodity costs to put their stuff out there to make the merchandise. And then number two, you got to worry about who's going to spend, who can go in and spend this money. I mean, discretionary incomes continue to be weak. So from a retailer's perspective, you want to be very selective. I would recommend focusing on those companies like an Ann Taylor or Nordstrom. As long as women are buying dresses, that is a good sign.
Okay, Todd, as always, thank you so much for weighing in on all these topics.
All right, thank you, Remy.